Geoff Lewis, Global Market Strategist at JPMorgan Asset Management, joins us from Hong Kong with his perspective on the global situation. Geoff, good to have you on the show. Thanks very much for taking out the time to speak with us today.
That's my pleasure.
Just wanted to start off with the big sell-off that's really happened globally overnight, with the U.S. markets also now officially coming into the red zone for its year-to-date performance. What is the expectation going forward? Is this likely to continue? Is Argentina pretty much at the helm of for this sell-off, or is it just the market looking for a reason, given that the U.S. markets were trading at record highs, that this correction has come about?
I think it's basically an excuse for some profit taking, so I don't expect it to be a really deep or extended correction. The history of the last couple of years is that we've been looking for corrections, and they haven't really been as long or as steep as most people thought was necessary. So the market has continued to want to go up. There are so many things going on at the moment, such as Argentina, Ukraine, Russian sanctions, European deflation, stronger unit labor costs in the U.S. I think it's difficult to attribute any one of these variables as the reason for the recent sell-off. I would put my money on basically this is about a profit taking.
Well, for the moment, it looks like it's about a profit taking, and more than anything else, I think the complacency has got challenged. Geoff, I would like to draw your attention to the dollar index, which is now sitting well above 80, and as we speak, the dollar index is at 11-month high. What could be the short-term ramifications of such a sharp move in the dollar index?
Well, I think that would be something of a headwind, perhaps, for the emerging markets. Our view is that the dollar has reached a multi-year inflection point and should be on a strengthening trend, but it will be a relatively gradual trend. So clearly, the dollar will be helped by the strong rebound in GDP that we saw in the second quarter, and also by the Fed recognizing that the labor market is tightening a bit, that we're getting a bit closer to their 2% inflation target. So there were some changes in the FOMC statement as well, which suggest that the Fed may be starting to shift its ground a little bit.
Now, what would that mean for the market then, if you are looking at the Fed perhaps likely to move up on rates much before expected?
Well, I think there is a possibility that the Fed will raise interest rates maybe a bit earlier than the third quarter of next year. After all, the unemployment rate has now come down to, it's not that far from the Fed's preferred range for the full employment level of unemployment, which it puts at 5.4 to 5.8%. So there would be a knee-jerk reaction. Normally you see the Treasury bond market selling off some 3 to 4 months ahead of the first rate hike in the cycle. And there would undoubtedly be a knee-jerk response to equity markets, but that should prove temporary. We don't think it will be the end of the equity rally, although it will mean maybe negative returns from investors in U.S. Treasuries and other G7 sovereign bonds for a while.
Geoff, India has been the market of choice for global investors. India, for the moment, is the best performing emerging market, and it is one of the best performing market in the world. Do you think the outperformance in Indian equities is here to stay, irrespective of global cues?
I think there's a very strong story here. There's a very strong domestic story. Of course, the impact of Modinomics on the supply side in India we won't really see that in the data for a number of years. But we are seeing the government's hitting the ground running with an awful lot of measures having been announced. And it does appear to be determined to carry its program out. So I think the fundamentals for India do look particularly good, and I think foreign institutional investors are particularly looking at the larger emerging markets, which have a strong domestic side to the story. So from that point of view, Of course, the Indian market has run very hard this year, so a correction in summer months is quite likely. But I think on a long-term basis, the trend is definitely upwards. It's a market we're very happy to be overweighting.
But, Nikunj and I were just discussing a little while back about the differentiation strategy in emerging markets. With S&P declaring Argentina in default, do you think that this would be a bit of a step back, really, for the overall EM strategy that funds such as yourself have? Or is it going to be one market and its own merit to decide further allocations?
I think the Argentina problem has been known about for a very long time. It's idiosyncratic. It's a tussle between the Argentinian government and the so-called holdout investors of the original Argentinian bonds from 2001. And I think the U.S. legal decision is actually forcing this issue to a head. So at some point the uncertainty will be over. And professional investors in emerging market debt, I think, look relatively favorably on Argentinian bonds at 8.5%, 9%. So I think this issue will actually be resolved. And I don't think Argentina is seen as a systemic warning to other emerging market debt markets.
Geoff, what worries me about India is the following, which is the sentiment has changed. India is more like a crowded trade, but the economic reality so far has not improved.
I think it is becoming a crowded trade, but then I think economic reality in the sense of a cyclical recovery. We are seeing upward momentum in industrial production. We are seeing some better numbers, and we've seen some useful declines in inflation, and of course a tremendous improvement in the trade and current account. So I think the macroeconomic numbers are getting better, but of course there's a long way to go before India recovers the strong growth trend that investors are assuming Modinomics will lead to. So there's a lot to prove, but I think the numbers are starting to turn in India's favor. It is a popular trade, but then if it was unpopular, the market wouldn't go up.
So, given that we are already up 20% plus for this year, how much more upside would you give to the Indian market from these levels, because you have another 4 or 5 months to go for the year?
Well, that's right. As I said earlier, I think it's quite likely that in the summer months we'll see a dip and a correction. Markets don't go up in a straight line. So I don't think one should be greedy and hope for double-digit returns in what remains of the year. It's likely it'll be choppier, I think, but on a longer-term basis, I think we should look forward to reasonable returns in 2015 and going forward.
Geoff, final question now. Indian markets clearly has two pillars, the export pillar and the domestic pillar. Export is IT and pharma, domestic is cyclicals and banks. Which pillar are you betting on? What are your overweight positions? What are you buying and backing in this rally?
Well, our Indian fund management team, they take a very bottom-up approach, but they can find value in quite a few sectors. They're looking at domestic cyclicals. Obviously, they're looking at those which will benefit from a revival of infrastructure projects. They're looking for those companies that have got sold down because they didn't have the finance to proceed with many of these projects, and now many of those are in a better situation with regards to securing financing. So there are those kind of stocks, cement stocks, obviously, but also we're not abandoning the export sectors. We see a stronger global economy. We see stronger markets in the US and Europe, and in particular, I think we're going to see good results also from the IT sector. So basically, we're not making really heavy bets. The other area, of course, that we like is financials.